Welcome to the Happy Cows Eat Smart podcast, brought to you by Novus AgriScience, where your dairy's business success is our passion. In our monthly podcast, we cover updates and insights within Federal Milk Order 33. Our team of expert ruminant nutritionists delivers research-backed, custom feed solutions tailored to your herd, because we know every farm is unique and no two solutions should ever be the same. We go beyond nutrition. Through robust tracking of herd metrics and financial benchmarking, we help you optimize costs, boost performance, and build profitability so you can focus on what matters: happy cows and a thriving business. So whether you're tuning in from your office or your truck, join us each month for insights, stories, and strategies that promote herd health, farm performance, and dairy success. Let's make your business thrive, one episode at a time. And now, Dr. Lawrence Jones will share his insights for Federal Milk Marketing Order 33.
Thank you, Ben. And I thought I would start this version of the podcast just a little bit differently, because this market has been really hard to understand recently. And so what I've been arguing for here recently is that we've got a really seismic shift in the market between non-fat dry milk and butter and cheese. And I thought I would try to explain this first and have you kind of think it through. So on the non-fat dry milk side, historically, the balancing plants take the surplus milk, make non-fat dry milk, and I'm going to say they make cream. Now, they may make butter themselves. But what we're finding right now is the increased cheese capacity is really sucking up all this surplus milk, and the balancing plants aren't getting them. And consequently, we're just simply not making non-fat dry milk. And we've seen this come with this graph here, which is the ratio of butter to non-fat dry milk. We're very stable, for 7-8 years, but then all of a sudden we started on this upward trend as to where we're making butter but not making non-fat dry milk. And I've been arguing that part of that is the fact that we've got such high components in milk that we don't have to separate off the non-fat dry milk. We're just going to take the cream off of a lot of the other products. Nonetheless, what's happened with non-fat dry milk, it's just gone parabolic here. This graph has the global dairy trade in blue, and then the spot non-fat dry milk. And historically, we were always 20 cents under the global dairy trade. And what this is saying is that the price of non-fat dry milk domestically is just completely disconnected from what the global market is. Now, butter has a whole different kind of scenario. Now, I've been arguing for the last few months that we're just making entirely too much butter. We've got too much fat in milk. But man, did something change back here in the beginning of 2025. This bottom graph is the exports per day of butter. And historically, we didn't export very much because we make an 80% salted butter, and the world wants an 82% fat unsalted. Well, all of a sudden, industry got its act together and said, hey, we're going to make what you guys want, and we're going to start exporting. So then one of the things I calculated is how much butter did we make, how much did we export, how much is left. And so this is the December data, because that's the latest exports that we have. So if we go back a year ago, we had about 6.2 million pounds per day of butter to be used domestically. In November of this year, we've only got 5.1, let's call it, and now we're at 5.8. So we've had a significant reduction in the butter available for domestic use, even though we're making more butter because we're exporting so much. And then on the other side of the ledger is cheese, and it's got a completely different story. So this graph is exports per day. We've been increasing. We've really never broke about 10% of actual production. So I did exactly the same thing. Here's how much cheese we make. Here's how much cheese we export. Here's the remaining. And let's put it on a per day basis. So a year ago, we had about 35.5 million pounds of cheese a day available for domestic. November, we're at 37.1. And December, we're at 37.4. So cheese is widely available, and we've got a lot more, even though we're exporting a lot more. So I think the story on all three of these commodities is completely different. So overall, I'm fairly bullish on non-fat dry milk and butter, which means I'm bullish on class 4, but I'm fairly bearish on cheese. We're talking about exports. Let's see what the latest prices are relative to the global dairy trade. Butter came up 25 cents, so it's a very, very strong. We're at $1.81. Global dairy trades at $2.82. You say, well, why aren't we kind of following that? We've also got this situation in the industry where Plants can make just enough 80% salted butter to populate the spot market and drive our prices down, while they export the other at a much higher price. And that's something that we've kind of seen develop here as we've got more specialized in the price discovery. Cheddar came down 2 cents, 2.15. Right now the spot market's around the $1.52. And then, as we said, non-fat dry milk is just way over top of the global dairy trade. Another thing that's impacting kind of the volatility are the different milk sheds. So what I'm hearing is in California, milk is fairly plentiful, and so milk for cheese is around $11, while in Texas with that new plant, they're trying to get as much milk as they can, so they're paying $18. So here we have $7 difference, a hundredweight, between two different milk sheds. And that's consistent with the latest data we got from USDA. This comes out on every Friday, but basically it's saying that the California production is very strong. And again, you can stop and read that if you want to see more of that. Now let's turn to prices. Overall, your milk price dropped about $1.36. Percent fat, percent protein, both dropped, as well as the prices. So when you put that on a hundredweight basis at $17.92, and that's exactly what the USDA is reporting, with the statistical uniform price being $15.92. So here is our statistical uniform price. This would be the lowest price that we've had since back here in the spring of 2021. A couple things impact the statistical uniform price. It's obviously the class prices, but it's also how much of each class. So class 1 and class 2 came down. Now class 2 came down the most. They went from 22% down to 2%, so it was a significant drop. Class 1 dropped from 35 to 32. Now class 3 actually came up a little bit, about 6. Again, these all add up to 100, so if something goes down, something has to come up. And class 4 was down. So here's our class 1 price. It came down $1.86 to $16.35. Again, we add $3.80 for order 33, which gives that $20.15 for class 1. The fat price came down about 12 cents, and the components came down about 2 ticks, from 4.50 down to 4.48. So overall, the price of fat was down 12 cents. It's $1.45. That is the low we've had for the year, way off this high of 2.84. Now, order 33 is just continuing to pound out these commodities. Compared to a year ago, we're up 4 ticks, even though we're down just a little bit compared to last month. And the lows are getting higher also. So let's compare you to the rest of the country at 448. The powerhouse right now is Texas at 460. And overall, the country came down about 1 tick, down to 446 in the federal milk marketing data. So protein percentages came down 2 ticks, from 347 down to 345, and price came down 27 cents. So this had the biggest impact on price, with having a impact of $1 negative. So protein was $2.12, down 28 cents. Again, not as low as we were back here in May at $1.87, but definitely off this high that we had back in November. And again, you're increasing protein percentages not quite as fast as fat, but you're 345, last year were 339. And again, we compare that to the rest of the country, you're 345. Texas is the powerhouse on protein, also at 358. Other solids basically didn't change in price, only about a penny, and so they added about 6 cents to the total impact. But the price of other solids was at 44 cents, up a penny off of the low of 29 that we had back here in June. So we take these top 3, fat, protein, other solids. That's actually what makes up your class 3 price. Now this is class 3 at 3.5 fat, as opposed to what the average is for order 33, but that came down $1.27 to $14.59. That is the low for the year, with our high being $20.18 back here. Now, interesting, this contract closed at the low at $14.59, and 6 months out, it was $3.14 higher, and actually 4 or 5 months out, it was even higher than that, but this has just been a straight down in this contract. Finally, the PPD came up fairly significant, about 18 cents. Now that's going to be driven by, what are the different percentages, what are the different prices, and how it compares to class 3. So class 1 was $5.74 higher than class 3. Class 2 was lower, class 4 was lower. Overall, the statistical uniform price was $15.92. This suggested that the PPD should have come in at $1.69, and it actually came in at $1.33. So here was our class 4 prices. They came down 9 cents to $13.55, way off of that high a year ago at $19.90, and that was the low for the year. So for right now, class 4 is higher than class 3. For the next 12 months, we've got class 3 around $17.44, class 4 around $18.73, but the trade has put in a fairly high premium, so we'll see if these actually hold or not. So what can we kind of expect to happen here? So month over month, we should continue to increase production basically through April. So again, we're going to have the spring flush here. As I said earlier, that the milk production for January came in at 1.4% month over month. Then we're going to be declining milk production, all the way through about December. But with the milk production report, we got some significant cow numbers where it had gone up, dropped a little bit, and I think that's what the trade thought would happen. But again, we added 21 more thousand cows in the last 2 months to come up to 9,580,000. Last month we added 14,000, and again we were up 1.4%. Now it looks like fat could be up 1.8% with the components that come in here. So driving these cow numbers are the slaughter data. So this is the latest slaughter data for February the 1st, which was 60,524. Now it's real easy to say, hey, these slaughter numbers are increasing, but remember we've got a lot more cows. Last year we had 9.4 million, now we got 9.6 million. So you've always got to put it on a percentage basis. So we're slightly above this 30% that I use as kind of where I think the herd is stable. But one of the things that we kind of got to keep an eye on here is my data would kind of suggest that we're up to about 0.75 heifers per cow. We'd been about 0.73. So we might actually be having a slightly larger heifer herd, which is going to continue to grow this overall dairy herd. So the big thing that we're watching right now is the spot cheese price, because that really is going to drive class 3. We had this one channel that we were in, basically 163 or 4 up to 185. And then starting in November, we dropped out of that, and we've been in this other channel, which is basically 130 to 150. We dropped out of the bottom of it, and we're slowly coming up here. Now the question is, are we going to come back into this channel, or are we going to hit resistance at $1.50? And right now it looks like we might be hitting the ceiling here at this $1.50. All right, just real quick on grain prices. We're in a time of the year where the WASDE reports and those sorts of things don't give us a lot of information. Corn is about 159 a ton without basis, and soybean meal is around 315. Both of those numbers are higher than we'd seen in the past. Partly our PE index is now pushing 2 relatively hard. We'd been in that $1.70, $1.85, and again that's 8 pounds of cornmeal, 8 pounds of soybean meal just as an index. Now feeder cattle remain fairly strong. They're up a penny to 358, and live cattle are up a penny to 237. And overall our 50-50 blend, which again is not very useful now that we've gone to the new federal milk marketing orders, is up. And as a consequence, our dairy margin is up, but this is still under 14. Kind of the higher end we need to get on this dairy margin. It was around $14 to look more positive. And then finally, just looking at the weather here, we're going to have a lot of warmth building in the west. Looks like you guys may get some clippers coming over this high here with a little bit of precipitation both out here and kind of Montana, Idaho, and also in the Northeast just a little bit. But the big question is, are we going to have another polar vortex? Are we going to have a really late cold spring? And this is the winds at 60 degrees north up at the polar vortex. So this has dropped off last year, which had that real cold inversion. This kind of dropped down a little bit, but is coming up. But if we actually look at this polar vortex, put you in orientation, here's the US down here. This thing is beginning to collapse here and is probably going to move over to the North Pole where it belongs. And so I think we're done with the polar vortex for the year. So that means that we've got to start looking at the next thing, and that's the drought monitor. Michigan doesn't look to be in too bad a shape, but there is this big corridor from Texas up to northwest Ohio, and a lot of Florida and a lot of the eastern seaboard that's fairly dry. So we definitely need a little bit of precipitation to come out of this wintertime drought. All right, Ben, now back to you.
Thank you, Larry. Novus AgriScience hopes you found this information insightful and look forward to next month's installment.